Hello and welcome to Crux Investor. We spoke earlier today to Jeff Quartermain, who's the CEO of Perseus Mining, an ASX gold producer with assets in West Africa. If you want our thoughts and opinions on that conversation, and indeed the company itself, you can find that at cruxinvestor.com/club, where you can also find detailed company reports, market commentary from experts from around the world on a variety of commodities and companies. There are training videos and summaries of other interviews that we've done, and of course a thriving community of investors sharing their thoughts and ideas with each other. And if you go and sign up for the waitlist now, you qualify for a 7-day free trial. And of course we'd love your feedback and thoughts as well. So do give us a like, leave your comments below, and if you want to see what we talked about, take a look in the description below. Good morning, Jeff. How are you, sir?
I'm very well, thank you.
Of course, it's probably afternoon, probably end of the day for you. You're in Perth. How are things there?
Things are beautiful, actually. We're heading into summer and looking forward to it. It's perfect weather at the moment, I must say.
Gorgeous, absolutely gorgeous. Are you getting a bit stir crazy? Do you want to be sort of jumping on planes and getting onto sites?
No, not really. No, well, I mean, we certainly haven't been there for very long, but I must admit it's been really nice to spend a bit of time at home and spend time with the family, so I'm not complaining too much.
Beautiful, beautiful. Hey, so look, whole new audience here. Could you give us a 1-minute overview of your story, and then I'll pick it up from there?
Yeah, sure. So basically, we're headquartered here in Perth, but all of our operations are in West Africa. So for all intents and purposes, we're a West African-focused company. We've got 2 mines at the moment. We're about to bring our 3rd on stream, operating in a couple of countries. So multi-mine, multi-jurisdictional. Started off from being a fairly small explorer, and we've had a pretty interesting journey over the last 10 years to get to where we are today.
Well, isn't that the truth? Mining's not easy, right? But your quarterly came out recently, and I think, it was some good numbers in there, but the market hasn't reacted the way that you probably hoped it would. Why do you think that is?
Well, it's a very good question, actually, and nobody can really put a finger on it, to be perfectly truthful, because it was a very good set of numbers, and we were reporting on, advances on our development projects, et cetera, et cetera. I think probably if I had to name a single thing, I guess there is some nervousness in the market around the electoral process in West Africa. So both Cote d'Ivoire and Ghana are heading into elections fairly shortly, and I guess historically that has been a time of some volatility, and some investors may well feel a little bit anxious around that, not to mention, the entire, equity market around the world, to be frank, at the moment.
Right, okay. I mean, it seems to be, looking at your share price, it seems to have sort of followed gold, seems to have tracked gold quite well. Gold's, I think you started doing quite well at the end of last year. You followed the dip in March, and you followed the rise of gold this year. And I think a lot of gold companies have done that. So the market seems to be giving credit to the gold price and not to your efforts. Would that be fair to say?
Well, I think that you could possibly say that's right. I think the thing is this, that if you go back in time, when Perseus first started its life, we did go through a few fairly challenging years as a single mine company, with a fairly difficult operation, I might say. And so I guess, we're in the stage where it's proof of concept, basically. And as we go forward, each quarter on quarter, we're laying down a consistent record of performance. And, we're very comfortable that we're on the verge of making an irrefutable investment case for people to look at, and hopefully have people forget about what transpired in the early years of the company and look at what we're actually doing now and what we'll deliver into the future, because it is tremendously exciting.
Right, okay. Well, I'd love to actually dig into that, if I may, because, if you're dealing with legacy issues from a long time ago and you feel that people are still judging you by, those measures, you're right. It's lots of baby steps that you've got to deliver to show consistency. So let's talk about that. So you were, as you say, explorer 10 years ago, and you've built your 1.5 billion Aussie market cap today. That's a sizable, meaningful company. But you've got to show growth. You've got to show the ability to continue to grow. So can we talk about what you set out to do in the early days and how you've kind of got to where you are today? Because I would then be interested in having a conversation about how you future-proof the company and show that growth. So maybe if we start off with a kind of business plan.
Well, I think, to be perfectly frank, when the company was started, the plan was fairly very short-sighted in the sense that the guys were explorers and they wanted to get out and do their thing and what have you, and then made a discovery, and a bull market came along. The last bull market came, and before terribly long, they had moved from an explorer to a developer and to an operator. In fact, I sort of, in my sort of more thoughtful moments, to refer to Perseus as the accidental miner, because I don't think that the people who set the company up and got it running really ever had in their mind that one day we would be a multi-mine, multi-jurisdictional business. They were sort of thinking about getting enough ounces on the balance sheet to be able to attract a very attractive takeover offer. But that didn't happen, and then the rest is history. So the thing was that I took over running the company. I joined as a CFO originally, but I took over running the company early 2013 when the gold price was into a fairly steep decline, and life was looking quite challenging. It became very, very apparent to me that the nature of the asset that we had and where we were located, being a single mine, single jurisdiction company, was a very, very difficult way to earn a living, and that we should, as soon as we practically could, branch out into another country, another operations, and spread the risk across the business. And so that was what we set about doing. However, before we could have that growth, we needed to get the first mine operating properly. And that took quite a bit of doing, I might say. There were a few legacy issues that needed to be addressed, and it took some time to get them right. Now, once we did that, we went out actually and made we had a second project available to us. The Sissingué project in Côte d'Ivoire, which is relatively small. But before we developed that, we actually took over a British company, Amara Mining PLC, that owned a very attractive project in Côte d'Ivoire, which is called Yaouré. Now, contrary to a lot of people's thoughts, we went and developed the Sissingué mine straight away before we developed the Yaouré project. And there was a very strong industrial logic in that, because we could get the Sissingué mine into development very quickly, give ourselves a second cash flow stream, second production stream, diversify the risk. And also what we could do is learn how to operate in a new country without exposing the whole, leveraging the whole company's success to it. So the Sissingué mine cost us $106 million to build. It was quite small. But I'm very happy to say that by 2 years later, we'd paid that entire $106 million back, basically. We generated $106 million in free cash. So since then, we've been going extremely well. And that second income stream has just given us a little bit more flexibility in dealing with, how we wanted to take the company forward, which has involved we're now building the Yaouré project. In fact, we should be producing first gold from there in later this year. In fact, in December, we'll be pouring our first gold from Yaouré.
So that's the journey. You've removed single asset risk, single jurisdiction risk, and you're a producer. So you kind of got that valuation to you. But again, if just looking at the share price, it's with big companies come bigger problems. They're different sort of problems, and they're bigger problems, and they cost more. And it's a different set of skills required to deal with that. So rather than sort of spend time talking about the quarterly, which I think people have poured over, and you've done a lot of interviews on, let's just talk about the growth component, because that's what fascinates me, how big companies have to just work hard just to stand still, right? So where's the growth come from?
Well, look, just to put it in perspective, so right now, this financial year, we produced around 270,000 ounces of gold. By fiscal 2022, we'll be producing 500,000 ounces of gold. And we'll be doing that for the foreseeable future. At this stage, we've got about 4 and a bit years of inventory that we can produce. So, we've gone from being a small producer to 500,000 ounces. Now, the challenge for us is to keep replacing what we consume, and if possible, to increase it as well. And so, look, we've looked at that situation and we've said, right here, well, we're going to be generating a lot of free cash flow. We are generating a lot of cash now, but it's going to become even greater. For instance, just to put it in perspective, so last quarter we made about $630 an ounce. Now, if we're producing 500,000 ounces a year, that's a lot of cash flow, $300 million of cash. And the question is, well, how are you going to deploy this for the benefit of all your stakeholders? And, we see that there are three competing uses. One is to manage our balance sheet. Two is to reward our shareholders through a dividend stream. And three is to continue the growth profile of the business. Now, if we look at, how are we actually going to execute that? We're looking at the broad cycles and things at the moment, and we say, well, where the gold price is very, very expensive to do acquisitions. But we've got a very good portfolio of exploration assets that we've had for some time, and we haven't really had the financial capacity to properly explore them. So for us, the key is going to be organic growth, and that is growth through the drill bit, basically. And, we're in a situation now for the first time ever where we've got sufficient cash flow to properly fund the exploration of those tenements. Very recently, in June of this year, we made a takeover bid for, and we successfully completed that in September, for a small company called Exore Resources. And it has a 2,000 square kilometre land package just adjacent to our Sissingué mine. Now, we started drilling there on the weekend, last weekend actually. And, we'll be having a feasibility study on that particular project early in the new year, in the March quarter. And, we're very confident that acquisition is going to, give us the wherewithal to keep that Sissingué mine going for quite a number of years beyond where we are. We've also, through the Yaouré project, which, as I say, we're developing that as an open pit mine, but since we've got that, we've discovered that there's actually a massive amount of mineralisation on those tenements, and in particular, there's a huge opportunity for us to develop an underground mine off the side of one of the pits. And if that concept can be proven, which we'll be seeking to do in the next very short period of time, then we've got a very, very decent life ahead of us, and in fact, quite an interesting growth curve that I think is the equal of just about anybody of our size in the global gold market.
Okay, why you talk about 630 cash margin? Why is this in this environment? It seems quite low. I mean, were you hedging? Was that the problem?
Well, we do a little bit of hedging, but the average price that we sold at was around $1,600 for the quarter, and that did include some hedging. And so, the average cost across the two operations was in the $900 an ounce. So that's about right, $630 odd an ounce. Now, the thing about the hedging is that we do hedge and unashamedly hedge. Our hedging kept the business alive back in 2013, 2014, when the rest of the world was starting to get very anxious around the thing. We're hedged to the extent that 20% of our projected production for the next 3 years is covered at just a touch under $1,500 an ounce. Now, if people are concerned about the fact that we're not selling 100% of our spot at our gold at spot price, what I would say to them is this: we're selling 80% of our gold at spot prices. We're selling 20% at hedge prices, and that small sacrifice in revenue gives us the certainty that we can survive in a very, very difficult environment. Because one of the things that we have done in terms of setting up our strategic plan is to say we want to produce a minimum of 500,000 ounces a year, and we want to do it at a cash margin of no less than $400 an ounce in the event that the gold price gets down to $1,250 an ounce. So that's the basic, that's what underpins our thinking. And of course, in this sort of price environment, I mean, we're very happy to be selling at $1,800 or $1,900 an ounce. Let me assure you, we don't offer to give any of that back. So we'll take it while we can get it. But we do like to think, we're running a business for time. This is not a speculatory company. We're trying to run a proper business here, where we can generate sufficient cash flow to make sure that we can create benefits for all of our stakeholders. Now, this is a lot of companies say this, but we genuinely mean that. All of our stakeholders, shareholders, host communities, host governments, employees, suppliers of goods and services, all of them deserve to get benefits from our activities. And you mentioned the infrastructure that we've built around our mines and the like. And then you're right, we have invested in that, replacement housing and things of that nature. I mean, for us, the idea of sustainability is not a theoretical concept. We are a guest in countries where we're not citizens of. We're guests in Ghana and we're guests in Cote d'Ivoire, and we have to earn, the right to operate in those countries. And we seek to earn that right by ensuring that both the local people and the broader countries have, we generate some real benefits for them by having us in their midst. So it's not a theoretical concept. It's very important. Sustainability is a terribly important part of our business.
No, for sure. It's ever more important. Can I just talk about the mentality of, because you joined in 2013 when it was still a relatively small company, and you've had to grow with the company in terms of your thinking and attitude. So you talk about hedging, unashamedly pro-hedging. And is that a historic thing because of some of the things you experienced as a junior miner? Or is it saying that's a realistic, cautious approach for a mid-tier company, given we don't know what's going to happen in the future? I want to say, are you still thinking in a legacy way? And is any of your other thinking affected in the same way? Or do you think it's good, prudent management?
No, it is. Look, as the CEO, my job is to manage all of the risks in the business, right across the business. Now, the biggest risk that we have is price risk. So I think it's a fairly false situation if I'm busily managing all of the risks except the biggest one we face. And so this is just simply part of an overall risk management strategy to make sure that our business can be around for the long term.
But Jeff, everyone's saying gold's going to go to $2,500 American dollars. You're being too cautious, aren't you?
Well, if gold goes to those prices, guess what? We'll sell 80% at those spot prices. How good is that?
That'd be good news indeed. No, I just sort of respond to some of the commentary that's come into us that perhaps
for sure.
You're perhaps being too negative. And because because if you think of it in the context of your mines, okay, I think Edikan is less than 10 years, Yaouré less than 10 years. I'm not quite sure what Sissingué is in terms of life of mine there. So you've got a lot of work to do to kind of expand that. We'll talk about growth and exploration in a second. So you're forward looking into multiple cycles going forward. So what is your view on the gold market? What do you think it's going to do?
Well, that's an excellent question. Look, I think it can clearly go up, down, or sideways, right? There's a straight answer for you. However, having said that, looking at what's out there, you'd have to think that the betting is that it's going to stay strong for some time. And we're encouraged by that. However, I'm not as young as I look. I have been through a few cycles, and I do know that from time to time it will come down, right? So we need to make sure that under that scenario that we're in very good shape. One of the things that we are keen to do is to generate quite a lot of cash and hopefully take advantage of the next cycle, because we'll have the wherewithal to perhaps grow the business at a time when other people are struggling, and that's all part of the longer term thinking here.
Well, that's interesting. Okay, you did your Exor acquisition. You paid about a 70% premium to market with the 20-day VWAP. I think you had a couple of calculations in there, but you're going to have to recover that and some. So what's the kind of what are you estimating the kind of payback on these acquisitions? I think it was like June, September that those negotiations went on. So you have to pay a premium in this kind of environment, and the price is already high. So you just said we'll take advantage in the next cycle when things presumably back down. When would you prefer, or when would you really like to be doing business?
Well, look, the thing is this: we look at situations and we work out how much money can we make from an investment. We looked at the Exor situation, and we're very comfortable that we are going to make a substantial return on the money that we have paid for that asset. And we've started the exploration confirmation drilling right now. And while the results are coming through, we're very comfortable that our analysis was sufficiently prudent to be able to generate a substantial return on the funds employed.
Is it a similar sort of drilling? Because I remember, I think I spoke with Justin Tremaine earlier in the year. I mean, it's a slightly different profile business than the one you run.
Oh, no, Justin, they declared a mineral resource, about 530,000 ounces, actually. Now, when we evaluated the situation, we discounted that number. We felt that there needed to be a little bit more work yet to be done before one could bank all of those ounces. But on the what we saw in the company, we're very comfortable that the price we paid, even though it did reflect a premium to the market as it was then, it was a very, very a good price for us to be paying, particularly given what we can do from here. Because bear in mind, we have a plant at Sissingué that's located 60 kilometres up the road, and that plant is one of the more efficient plant, processing operations going around. In fact, from day one, the runtime, throughput rates, recoveries, etc., have been well in excess of what we expected them to be. And so by being able to keep that mill fed, we stand to make a lot of money. We don't have to rebuild the plant. We've already got one there. Okay. So no, I think we'll do very well out of that acquisition. Now, I don't think the market's fully factored that in at this stage of the game, and not surprisingly, because we haven't been in a position to disclose all of the facts around the economics of that particular project. That we're going to be publishing a feasibility study in the March quarter of next year, and I think when we do that, people will be able to see quite vividly for themselves, what the benefit of that acquisition is actually going to be for a company like Perseus.
Okay, so let's talk about some of that free cash flow that you're talking about generating from 2022 onwards. Obviously, between now and then, you've got a job to do. I think you've said that. But companies of your size start to go down the M&A route. They overpay, or they put the money back in the ground. And I know you've talked the language of paying dividends, but you're never going to be able to pay meaningful dividends, are you? Because, you'd rather see the growth come through the share price, presumably, and whatever you do, whatever money you're spending in the ground.
Well, I think that attitude has actually changed somewhat in recent years. And that was certainly used to be the view of gold companies, that the shareholders invested in you for capital growth, and that was the end of the story. I think people still want a capital growth. There's no two ways about that. But I think they're also starting to look for a return, or at least cover their holding costs, basically, in the interim period. So certainly from the conversations I've had with our investors, a dividend, albeit small, would be quite welcome, just to cover the costs of being there.
What sort of level would you be thinking about?
Look, at this stage of the game, I wouldn't like to make any comment around that. This is going to be a subject that we as a board discuss in some length towards the end of this year, as we sort of move on from where we are now. But no, look, it's something that we're going to have to consider very carefully. The one thing we are absolutely adamant about is that if we do start paying a dividend, we want to be able to do it in a way that we don't have to switch it on and switch it off or decrease it over time. So we'll need to find a mechanism where we can declare a dividend that we can comfortably sustain, and that any shareholder who buys a stock can do it in the full knowledge that they're going to be paid that dividend, albeit it might not be as big as some other companies might pay. Okay, so let's come back to that balance sheet then.
The type of profile of companies that you would consider buying is what? You're not going to go out and buy a Resolute, are you?
Well, what we're looking at, we're not going to buy anything right now, because I think everything is fairly well priced. So let's be clear about that. But no, the sweet spot for us would be to buy a late stage exploration project where we can deploy our development team to really add some value. Now, we've built 3 mines now, or we're in the latter stages of building our 3rd mine. So I think it's fair to say that we do have the capability of doing that. And so we would very much like to be able to continue to deploy those skills that we've acquired and that knowledge we've acquired over time by continuing as a developer, actually, as well as an explorer and a producer.
Interesting. Okay, so there's no doubt you can build mines, but that's the profile of the companies that you think you'd be looking to acquire going forward at the point you want to.
Well, that's the ideal. That's the sweet spot for us, for sure. Now, having said that, there are not an awful lot of those assets sitting out there saying "buy me" kind of thing. The ones that are out there have, generally attract a pretty decent bid, and it is quite competitive. So, look, it's a case of looking at all sorts of things, and not sort of going into any of this sort of thing with a closed mind. Now, at the moment, we're saying it's unlikely that we will find anything that we can acquire and generate the sorts of returns we're chasing. However, that doesn't mean to say that we shut up shop and we don't look. We absolutely look. We're constantly looking for opportunities, and And the thing that I think Perseus can say is that, given our track record since 2016, where we acquired Amara and more recently acquired Exor, when an opportunity presents that is one that we can actually feel we can make a decent amount of money off, we can execute. And we've done that twice. I don't think there's any doubt about our ability to do that, to spot value and then to execute.
Right. Okay. No, that's fantastic. Can you talk to me about your share registry? What's the makeup of that? How much of it is institutional?
Oh, well, it's largely institutional, probably overall at least 80%, I would think. But it's an interesting register. It's split between the United States at about 42, 43%, UK, Europe about 30 odd percent, 32% maybe, and about 20 to 30% in Australia. And so it is held on a global basis. Traditionally it's been the resources funds have held us, the bigger gold funds, the Franklins, the Ruffers, people of that nature. More recently, we've seen quite a bit of quant money coming into the registers. So we're seeing the Van Ex and people of that like. But I think that I don't want to sound vain around it, but I think the quality of our register is outstanding. We've got an excellent group of shareholders who have come in. And quite recently, we've had a number of people come onto our register, major institutions who 5 or 6 years ago quite openly declared Perseus as uninvestable. And now today they're very happy shareholders. So I think the transition that we've made is being recognised, and as reflected by the share register. And those people have been well rewarded to date, and I expect will be very well rewarded looking forward.
You've had a good run of it since the beginning of 2019 to today, for sure. But with large institutional registries come problems of liquidity, right? You kind of still need that retail mix or family office mix to kind of keep the trading going. But well, firstly, do you agree with that?
Well, it used to be correct to say that, but a lot of the quant money moves pretty quickly these days too. And, I think, we trade about 9 million shares a day on average now. If you wound it back, so maybe 2 years ago, we'd be lucky to have done 5 million shares a day. So over the last couple of years, we've seen significant increase in turnover. There's quite a lot of liquidity, and that's a good thing and a bad thing. It's a bad thing in the sense that, it's a good thing in the sense that people can buy into the stock and get out if they wish to. But it also then, if you do have high liquidity, you then become something of an investment vehicle, and you do get quite a lot of churning. So, it has its good points and its bad points, let me say.
Right, for sure. It's it was somewhere in the middle, somewhere a bit more Goldilocks-like. But the future proofing of the company is what people are judging you on today. Your shareholders are making money when your shares go up, and these large institutions have drivers of their own. They have a certain idea in their head about what they want you to be doing. I suspect it's around M&A, but what are they telling you that they want to see more of from you?
Well, I think the companies, the investors, they want growth for sure, no question about that. But they want responsible growth, and they don't want you, going out and just blazing away and overpaying for assets and the like. Now, I've just come off a virtual global roadshow last week where we spoke to many investors actually in all of the countries that I mentioned, and I think that overwhelmingly the feeling from the people we spoke to is extremely supportive of the organic growth approach that we're taking at the present time, recognising that inorganic growth, while it is possible, is challenging at the end of the market that we're looking at. If you look at, and lots of people talk about the consolidation of the business, and this year there has been quite a number of mergers that occur. But if you look at how it's actually the structure of it, at the big end of town, there have been zero premium mergers, so mergers of equal, if you will. But down at the bottom end of the market, the explorer still wants lots of money for their efforts, and there are premium being paid at the bottom end of the market. So I think that our investors say, yes, we believe you're right. You're not, the sort of people that you would consider investing are pretty darned expensive right now. And we agree that you can actually create more value through judicious exploration as well. Now, they're not saying go out and fire at will on the exploration front either, by the way, but we do have some outstanding opportunities ahead of us and things where we can very rapidly convert them from targets we believe into, JORC compliant reserves on the balance sheet, as it were. So no, I think that they certainly want that. But as I said, all of this is underpinned by the fact that investors want you to do this in a sustainable manner where you're treating your environment and your communities well. And so we would look at our business and say, well, what are the pillars of our business? Well, clearly the physical assets are exceptionally important. I mean, without them, you're not going anywhere. Secondly, we would say that the financial assets are pretty darn important too. If you don't have money to pay your bills, you're not going anywhere either. But the human side, the human resources is equally important, because it doesn't matter how good your assets are, if you can't have people who can actually operate and do things properly, you're not going anywhere. But finally, the sustainability piece is extremely important too, because you can have the best assets in the world, the most money, the greatest team of people, but unless you're welcomed in the communities where you operate, then you've also going to struggle at that point. So the sustainability side, where we look at OH&S issues, we look at environment, we look at community relations, government relations, security, all of these things, we believe they need to be attended to with the same level of vigour as we do our exploration, development and operating activities. And similarly, when it comes to human resources, and so in terms of future-proofing our organisation, we're currently looking at, are we structured appropriately? Are we adequately resourced? Do we have sufficient skills available to us in the areas where we need them? Do we have sufficient motivation and leadership to bring people through? Do we have succession planning in place? All of those things are necessary in order to be able to cope with the next phase of growth, which we will deliver, either through organic or inorganic means, as whichever is presenting the best opportunity.
In a bull market, people tend to lose their minds and the decision-making changes. So do you think the ESG, the green component, the sustainability element is enough to keep people invested in you whilst you go through probably a quiet period in terms of being able to demonstrate that growth, demonstrate what you're going to be able to do with the Exore resource in terms of exploration, your other exploration, the bringing Yaouré into production. You've still got some proof points to make there. You still have to show people that you're going to be able to do it.
Absolutely.
So do you feel that people get distracted by the shiny objects off to their left or off to their right, and then maybe think about coming back to you when you've kind of done what you say you're going to do?
Well, they may well do that, and if that's their approach, then we say, well, good on you, because that's fine. We set out some time ago to do a particular thing, and I believe that we're well and truly on the path to doing it. One of our core values, and we talk about our values, but one of our really core values is achievement. It's doing what you say you're going to do. We don't say we're going to do something unless we do it. And if you look back at what we have done over the last 4 or so years, every single thing that we've said to the market we're going to do, we've done. And we will continue to do that. For us, it's all about execution. We would rather execute and talk about it in hindsight than stand on a street corner and tell people what we're going to do. And that's a bit of a different approach. And I think that perhaps the fact that we haven't been quite so vocal over time may well have caused the share price not to be seen, in the same light as some of our competitors. However, we're not overly concerned by that, because we do believe that the weight of numbers will speak for themselves. The way we're building this company, and when I talk about the 500,000 ounces per year, that is between now and a year and a bit's time. But at the end of this year, we'll be producing from our third mine, and progressively that production level will incrementally increase. So, people say, well, what is it that's standing between you and that production level? Well, I think that we used to say there are three key things. One was financing risk, one was development risk, and one was operating risk. Well, the financing risk is not an issue any longer. We've funded the project, and in fact, we're well funded for that. In terms of development risk, we're within 2 months, I would say, of completely eliminating that development risk. We're very, very close to the final strokes on this project, and in fact, we're in the commissioning mode right now as we speak. So that leaves the operating risk. Can we actually operate our assets well enough to be able to deliver the targets? Well, what I would say to people who have questions about that, just take a look at what we've done for the last 15 quarters. and you'll see a very steady, line of production and, gradually decreasing cost structures, et cetera, that has come about by us focusing on the task at hand and doing what we say we're going to do. Now, are we going to change our mode going into the future? Well, I can't see a reason why we would. And I think that, for us to deliver on that promise of the 500,000 ounces at the margin, the cash margin we've talked about, it's all about getting down, getting your sleeves rolled up and doing your thing. And that's what we do best.
Jeff, that's a really good point to end on, the fact that you are consistently reducing costs as well. We hadn't touched upon that, and I think it's worth noting. Brilliant run through, Jeff. It's nice. We have not spoken before, and I've not heard this story from anyone in the company before, so appreciate your time today. It's a nice one. So do you want to leave us with one thought? So why should new investors be looking at you as their primary gold investment?
Well, a new investor wants to look at us to make money. And I say to them, well, if you look at what our price to cash flow multiple is today, and when you look at what the cash flow that's coming through as when the third mine kicks in, there has to be a re-rating in our stock price if we are going to be rated in a similar way to the peer group, which I'm sure we will in due course. So I think that, as a prospective investment, people stand to make a lot of money, and you can be absolutely sure that the company's in good hands. It's in safe hands. We're not going to do anything crazy, and I think that people who invest in us will do very well.
Beautiful. Jeff, thanks very much for your time today. Appreciate it.
Thank you indeed.